What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is September 21st of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and it feels good to be back home because we're kicking things off in a big way, diving into our expectations of the upcoming Federal Reserve FOMC meeting that's going to be held later today at 2 p.m. Eastern Standard Time, where we're going to learn whether or not the Federal Reserve is taking monetary policy in one direction or the other, and on top of that, where future outlook is going into the next couple of months for the federal funds rate and quantitative tightening. This is going to be a jam-packed episode, but we're going to try to keep things as concise as possible. I'm going to tell you guys my thoughts, the general market consensus, what it would mean for price if we go in one of the other directions, and on top of that, the things you shouldn't do going into the FOMC meeting, some of the big mistakes that people make. We've got a lot of things to dive into, so let's go ahead and kick things off. And if you enjoyed the video, consider dropping a like. Now, I want to go ahead and just talk about the general market consensus. Over 80% or more of economists, market experts, if you want to call them that, and different types of measurements are calling for a 0.75 point increase yet again in the federal funds rate. This has been the Fed's main tool so far in order to try to curb the rate of inflation in the economy. Now, this was made pretty clear, and the reason why the vast majority are at a minimum expecting a 75% basis point hike is from the Jerome Powell, the speech in Jackson Hole that Jerome Powell gave from the Federal Reserve. This was a very clear speech. The Federal Reserve is starting to move into the driver's seat. They're starting to take control on the rate of inflation in the economy, and they're going to do it by means of quantitative tightening after a more than decade-long run of 0% interest rates for the most part and quantitative easing, injection of lots of money into the economy. Now, I have to tell you all, just personally here, and this is going to kind of play into my expectations here for the meeting, I think that the Federal Reserve is doing the right thing here. It's starting to lean into the better side of the equation by starting to take control of inflation rather than letting it persist. Because if anyone knows anything about the history of inflation, not just in the United States but abroad, the longer you wait to tame inflation, the more painful it's going to be down the road. Just even a couple months to a year down the road of not taming inflation can mean a make or break for the economy and the separation between a temporary recession versus a prolonged, potentially decade-long depression that the Federal Reserve cannot just stimulate its way out of. We already know it can't do that because it needs to tame inflation. And that's why we've remained so hawkish here, even after the decline we've already seen in crypto, whether it be Bitcoin, Ethereum, and even the broader stock market. You guys know that I'm usually a passive optimist. I love markets. I think that in the long term, markets will generally move higher. But if we're talking about the short term here, it's important to understand the difference between the typical 20-30% bear markets where the Fed would always come in to support asset prices by monetary policy or by means of monetary policy. And the fact is that it just simply can't do that anymore. And now instead, it's starting to engage in quantitative tightening. And that is going to continue to weigh down the prices of assets. Now, just to let you guys know here, again, we've already been talking about this for the past couple weeks. We've seen how Bitcoin reacted to the CPI report. We saw how it reacted to the Jerome Powell speech back in August here, where all assets took a massive hit here in price. And I mean, just take a look at the charts. You don't need me to tell you this, guys. Bitcoin down here right at the low support range here. Again, while we have had consistent deviations where every time we came below here, we pop up. Again, I'm not saying you should go long into the meeting, but I'm also not saying you should go short here. We should wait for trend confirmation. All in all, though, I got to be honest with you all, the chart looks terrible. There's no optimism here in price. We've had consistent lower highs and lower lows here over the past couple of months since the relief rally we had in August. I think everyone now sees what we've been chatting about for the past couple of months, how this was a relief rally that was meant to be taken advantage of as speculators were coming in expecting that this was the final dip. This is a typical market structure of bear markets. We've already seen this a couple of times here since the peak back in November. Ethereum here looks terrible post-merge. Looks like it's ready to roll over and fade a lot of these gains, and at a minimum retest down here towards the lows here going in to the close of this year. I think it could get even worse. The ETH to BTC ratio starts to speak to this here. We've broken away from this kind of deviation in the market, this uptrend here for Ethereum. We got back up into typical resistance range against Bitcoin and are weighing down further. But what could be even more telling here when it comes to asset markets is taking a look at a market that a lot of people aren't watching in the crypto or equity space. And that's what's going on in the treasury markets, right? Treasury markets are some of the most hyper efficient to predicting what the Federal Reserve is going to do, and they will start to price in changes faster than anything else out there. Why? Because the federal funds rate has a massive effect on the yields that people are going to get on bonds and just the general supply and demand dynamics of the overall bond market, considering whether or not people are desiring essentially, in this case, the guaranteed rate of return utilized in the Sharper ratio. They want to essentially have a guaranteed rate of return to protect themselves, taking advantage of low bond prices, tapping into that yield that they can get, or rather going on the opposite direction of speculating on financial assets like stocks and crypto. Let's just take a look at these charts, guys. Right? You don't need me to tell you this. This is the weekly chart here. And since here in 2021, we have not been stopping here. We've continuously seen an expansion here. Even the US 2-year yield is pushing up right under 4% here. And this is coming at a time here where back a couple of months ago, people really believed the Fed statements that we were going to be aiming for a target rate of 3.5% or 350 basis points for the federal funds rate. And I think, as we've already talked over the last couple of videos, this is much more likely going to be 4%. Potentially 4.5, and even I think 5%, 500 basis points is where the Federal Reserve is at a minimum going to have to go here in the long run, not just in this meeting, but over the next couple of FOMC meetings, if it wants to do the right thing, if it wants to have a chance at taming consumer inflation. And while we've been seeing natural gas and oils, we'll take a little bit at later, starting to decline here, right? All the while, there has been some declines in certain commodities. The broader cost for consumers is still going up. We saw this from the CPI report, a lot of that coming from shelter costs, where we saw about almost a near percentage month-over-month increase, which is massive. And the bond market is pricing that the Federal Reserve is likely going to have to continue its game here. Now, we could see some changes here. Again, the FOMC meeting, these are big inflection points. But essentially speaking, the bond market is holding strong here. Week by week, we have had green up moves since back here in August, building off of that momentum from the Jackson Hole speech. And not to mention, on the longer term time frames here, we have been seeing a clear range of support on previous generational resistance. This is the big thing here, guys, why we are expecting that rates are going to continue to climb here, and why the Fed is, whether or not in this FOMC meeting or not, is going to continue to get more and more hawkish. Take a look at the US 20-year yield here, just like the 10-year yield, chartering higher here. The 30-year yield, this is probably the clearest example of this long-term end of the bond bull market, where yields are going to start spiking up, bond prices are going to get more and more lucrative, where people are essentially going to be buying the dip, taking advantage of the yield, and choosing this over investing in speculative assets. Bitcoin's chart is breaking down right near to new lows. Bond yields are starting to shoot up here. People want protection. They are betting here that the Federal Reserve is going to continue hiking. The dollar index here, which was starting to show some weakness here, but as time and time again has showcased, any time there's been a dip here in the Dixie, and actually now in much shorter corrections, people are buying it up. The CPI report was the solidifier here of the trend. We had a bull flag, continued breakout here. Day by day, we're seeing half percentage moves here for the dollar back to the upside, pressing to new highs today. And if the Fed comes out with a severe calling, and this is something that some market experts are talking about, a 100 basis point increase versus 75 basis points, showcasing that the Fed is ready to crush the global economy if it means taming inflation as its number one goal. That is going to send the Dixie soaring higher. And as we've already chatted about before here on the channel, our calling here, as we wrote about in the newsletter a long time ago here, back a couple months ago, is for the Dixie to come up towards around 116 to 117. That would be the proper thing to see here if the Federal Reserve is really in the driver's seat. If we get back up into this range, this is going to be the kind of conditions to put the Fed in charge and bring down inflation, where Jerome Powell will be seen as a savior comparative to Ben Bernanke and Janet Yellen, where even though it might be bad for asset markets in the short term, it's going to make it a short-term recession versus a depression, similar to what Paul Volcker did back in the 1980s. Now, take a look here at some of the other currency pairs. Euro looks incredibly weak going into the meeting. Looks like it's ready to break down to new lows. Great British Pound, clear downtrend here. No signs of changing here as far back here as May of 2021. And Japanese yen, again, still gaining weakness against the dollar. Again, we've got the pair flipped here. This is the more common FX pair, USD JPY. Dollar continuing to garner strength here for the past few years here against the Japanese yen. Now, I know a lot of people are optimistic about the continued elevation of oil and natural gas at lower levels than we've been for the past couple months. But we've got a couple things to consider here. As you all probably saw in the previous video, it's not just energy-based commodities we have to worry about. It's a lot more to do with the cost of living, i.e. rent and mortgages. The cost to live and own a home or to own a rental property, or essentially be living as a tenant in a rental property. But if you want to take a look at the energy-based commodities, it's important to understand that oil is still remaining elevated here at January lows here, right? Essentially around this $83 to $86 a barrel range. And on top of that, we've got a really big macro event that we need to talk about here, and that is the recent speech from Putin this morning. Now, I don't know what you guys think about Putin. Look, everyone's got different opinions. Everyone's got very, strong opinions considering the wars going on and everything. But the fact of the matter is that this is going to be a continued macro topic that is going to cause constraint on energy markets, therefore likely elevating prices. And with this recent conversation on military mobilization, potentially taking in up to 300,000 new individuals called up to draft in the Army, this is going to mean a severe set of concern across the board in energy-based markets. I'm here in Europe at the moment. I got to tell you guys, energy bills, even though they've started to come down here, at least the energy markets are showcasing down on some of the charts, it is very concerning to see just how high, not just oil has remained, but on top of that, how elevated natural gas has been. I mean, if you take a look at the previous corrections here, we used to at least get sharp corrections in the upward ascending channel here, but now what we're doing is we're setting a base foundation well away from the line of ascending support here, meaning that the fear is still riding really high. There is still talks of rationing, all these different discussion points. So essentially speaking, they've not only got to deal with this at the Federal Reserve, they've got to actually play a little bit of geopolitics here because they need to cripple the cost of oil and natural gas, not just to cool inflation, but on top of that, to have geopolitical pressure against Russia. But on top of that, they've got to cool the cost of living here. And that means that they got to shut down demand in the housing and rental markets. And officially, as the Federal Reserve does this, ironically enough, they're going to spike the cost of living beforehand. It is a necessary step because of the fact that they've got to shoot up the mortgage rates in order to cool consumer demand. And with that, with all the people out there who took as much credit and leverage as possible to go out and build, income properties, generally speaking, landlords who went out and bought a second, third, fourth, fifth, or investment-based properties from large hedge funds and firms, they took out any means of financing to go out there and build these rentals or Airbnbs. And the problem is that they're going to have to jack up their rental rates. If they took variable rate mortgages, about 15% of the market, so a good chunk of the overall lending that's going on in the housing sector. They are going to have to jack up rents in order to essentially meet to these new financing requirements from the increased federal funds rate. And this is going to be the natural step or evolution of the housing market the Federal Reserve eventually wants to get to. They need to cripple demand. They need to keep people from taking rentals. They need to shoot up housing inventory so there's more supply in the market and essentially cool down the cost of living. Ironically enough, though, this could, again, contribute to the CPI here in the next couple of months due to those increased costs. But the general key point here that I want to talk about to kind of wrap up this conversation point around our FOMC expectations. I got to tell you guys, 75 basis points, if you're doubting that at this point, that we're at a minimum getting that, then I don't know what to tell you. Again, I really don't mean to be too harsh on this, but we've echoed this a lot on the channel, and it's something that you need to be prepared for. If you're overexposed to crypto, if you're overexposed to stocks, and you don't have cash at the moment, it's going to be probably pretty painful for the next year or so, at least the next couple of months, irrespective of what happens today in the FOMC meeting. But I have to tell you guys that there are a lot of people who I admire, a lot of the hawks at the moment who, just like in a bull market, we want to follow those who are more risk on. We want to follow the Cathie Woods. We want to follow a lot of the people who essentially take up the headlines during a bull market, during bull markets, right? People who are more risk on during periods where it benefits you to be risk on. A lot of the hawks are starting to speak a lot more confidently about a 100 basis point hike. This has been in the conversation pieces for a while, but I have to say, do not be surprised if Jerome Powell, in an effort to regain confidence in the Fed, regain confidence in him as the head, the Fed chairman, in order to regain confidence that inflation is going to be able to be cooled down and that the U.S. is going to bring back equilibrium between supply and demand. Don't be surprised if he increases rates by 100 basis points and shocks the markets. If we get this, if we get a 100 basis point increase, you're going to see Bitcoin cripple down easily start the downtrend to 14K, as we talked about in the channel. And that's, again, not just our lowest price point we're looking for, but it's the next key goalpost here. You are going to see Ethereum crater back down to the lows, right? Maybe not immediately, but it's going to start the downtrend here, right? The ETH to BTC ratio getting crushed there as well. And you are going to start to see the 2-year yield, the 10-year yield, the 20-year yield, the 30-year yield, and the dollar all starting to surge higher big time. You're going to see the NASDAQ, you're going to see the S&P 500, the Dow Jones, all starting to take a hit, with the NASDAQ leading the way to the downside, with tech risk on, companies in which that burn through a lot of capital, who need to raise capital, who need to rely on cheap credit in order to continue expanding and growing. They're going to be getting hit even harder than they already have. The ARK fund, all these different types of kind of companies and hedge funds and investment funds that are overexposed to tech, all the stocks that did really well in 2020, 2021, made monstrous gains and went to ridiculous valuations, are going to get hit big time. And I'd say even the FANG stocks, which have a lot of weight in the market, are going to get hit big as well. So I'm not walking into this too optimistic. If the Fed does, on the other hand, only increase by 50 basis points and feels that they have a controlled inflation, you're going to get a pretty solid short-term bump in the market. But that's a bump that I'd be willing to short going into the next coming weeks and months when I start to see price getting overextended. Because if we learn from history, we know that inflation needs to be tackled aggressively. And if you wane back, if you start to pivot, it's going to get much worse before it's going to get better in the grand scheme of things. Now, one big question that I know a lot of people have in their minds at the moment is what's going on here in the altcoin market, especially considering the price action we're seeing from Ethereum. I got to be honest with you guys, I'm not too optimistic here in the altcoin space. I am looking for a lot of plays here that could do really well going into the next bull market. We're definitely looking for some valuable fundamental plays that are definitely exciting and are starting to showcase promise. But at the moment, we're going to be continuing to look for players that can, at a minimum, if we're going to be DCA, if we're going to be looking at plays to buy, as we get this dip opportunity, I'm going to be looking for plays that hold up well against Bitcoin. And one of those plays that I think is really exciting is Kava Network. They're our sponsor for today's video. If you guys haven't already checked out Kava, Kava is an alternative layer 1 protocol that merges the Cosmos SDK alongside the Ethereum virtual machine, two of the most powerful layer 1 protocols, and allows for deep amounts of liquidity to come from all compatible chains through bridges and networks to essentially bring in a lot of liquidity into one singular, hyper efficient and highly scalable network that has low fees and high scalability. But one of the big developments that they've had here back in early part of September that we've talked about here on the channel is the move and the migration of Curve onto the Kava network. They've deployed an iteration of the Curve protocol through the EVM on the Kava network, allowing for people to not only earn Kava rewards, but on top of that, be able to earn high yields through the Curve protocol. So if you guys are interested in this and want to learn a little bit more about it and dive into the Kava network, I definitely recommend you guys take a look into some of the articles they recently published out on their blog, talking about the steps on how to bridge any of your existing USDC or other assets into the Kava network, and on top of that as well, how to start deploying the Kava's implementation of Curve and making yield on your assets. It's really exciting to see big protocols moving over. Seeing this in a bear market is really telling about how much is being built on the Kava network. It's one of the few exciting layer 1 protocols we're keeping our eye on here on the channel. But anyways, guys, that is going to be it for today's video. I know that some of you guys had seen our poll that we put out here asking about doing a normal daily update in the live stream. And I know that we had some favoring doing the live stream. But to be honest with you guys, I'm a bit worried with the YouTube algorithm. I've been having some issues here when we do live streams and not everyone's seeing them. So what I'm thinking about doing, if we don't do a live stream later on today, is definitely doing an update sometime on Friday where we'll really go through talking about our post-mortem conversation here about what's happened with the FOMC meeting. But we generally talked about what you guys can be prepared with here today. And I'll try to put out some updates on Twitter. So if you guys want to get those updates later on, if I do publish them, you can follow me at Nicholas_Merton. It should be on my channel as well if you guys just want to go ahead and find it really quick. But that being said, everyone, have a wonderful rest of your day. If you enjoyed this video, consider dropping a like. And if you want to get even more market insights like this, you can check out the Dash Report down below in the description. It's our newsletter here on the channel. It's a great way to support me. But on top of that as well, it's a really interesting way to kind of get insight into the additional topics that we may not even cover here on the channel, even though we pretty much talk about a lot here on the channel. Anyways, that's it for today's video, guys. Have a wonderful rest of your day. Stay smart, trade safe, and I'll see you all in the next video. Take care, everyone.